Even though Tesla is up over 100% year to date, in the last month, it is down 12%. So it's probably on a lot of people's mind, is it the right time to buy the stock? So that's what we're gonna do today in this video. We're here to look at Tesla and figure some things out. So in this video, we're gonna go over some bull and bear cases. We're gonna go over some high-level metrics about the company. We're gonna go over analyst estimates that we get in our software. Of course, we gotta cover our 8-pillar process, and we're gonna finish the video off with our stock analyzer tool, because probably you're watching this trying to figure out how much should you pay for Tesla stock. So we're going to use that tool to determine that. I ask you to listen to this entire video and think about how our process can help you in your investing journey, in your process, and help mitigate your stress and anxiety about investing. Because the more you know, the less you will fear. And that's really, really important, especially in investing. Fear makes us do things that we will regret later on. So there'll be something in this video for beginners, as well as more advanced investors and all the way across the spectrum. So no matter where you are in that level, there's something in this video for you. Watch the entire video, and some things will be confusing no matter what level you're on, and that's okay. We're here to teach you, and we want you to learn, and the more and more you learn, the more videos you watch, the less confusing it'll be. It was confusing for me, and it was confusing for the over 200,000 people that subscribe to our channel at some point, and probably still is. I am still learning every day, so please stick around. Mo, let's check out Tesla. It is roaring crazy today. $720 billion market cap, which, guys, that means by every share outstanding, that's what you have to pay to own every single share in the company. Now, they did $94 billion in revenue last year, in the last 12 months, and they made $12 billion on that. That's not bad. That's 13% profit margin for a car company. Now, guys, I want everybody to remember, Tesla's big thing is they're not a car. People are saying they're not a car company. Mo, do you remember what percent of the revenue comes from cars?
Like 88 to 90?
Yeah, it's like 87 or 88%.
Yeah.
Guys, it's a car company. Now, it doesn't mean they won't transition to other things, but when 88% of your revenue comes from a car company.
For right now, they're a car company.
When Mo talks to me, he's actually a dick to me like 90% of the time. So that makes Mo a dick. That's it. If Mo was nice to me 90% of the time, it would make him
nice guy.
A nice guy. And these are the things you have to sit there and balance. It's no different than where the revenue comes to the business. And I see Tim, he just put his head back like, okay, what is going on here? So guys, in the last 5 years, they've done 4.7 billion in average net income, and they've generated 3.6 billion in average free cash flow. Okay, it's not far off, but it's lower free cash flow than net income. Okay, not terrible. But look at this, Mo. Last year's net income was 12.2 billion, and last year's free cash flow was 6 billion, half of that. Yep. I don't like that. Yeah. I don't like that at all. I want free cash flow and net income to be much closer. Now, there are probably things having to do with how much they invested in the company years ago and they get write-offs. No, actually, it's exactly the opposite then. They're probably investing a lot now.
You're right.
So Mo, go look at their cash flow statement so you can let us know how it looks there.
Let's see here.
Have they increased their capital expenditures?
Yes, they have.
Oh, wow.
Yep.
Holy cow.
They're almost at 8 billion.
Well, look at that growth there. Nope. So they were doing 1.5, 1.2, then 6.57 and 7.8 billion. Okay, so guys, here's the point. There's a story there. There's an explanation as to why their free cash flow is lower, because their capital expenditures are higher. They're building a lot of plants. They're putting a lot of money into the company to let it grow. So remember, they did about 1 million units in sales last year, but they want to grow higher. What does that involve? Building more factories. So they're spending a lot more money building factories. So that makes a lot of sense.
Yep.
Right? Yep. So Mo, what are some bull and bear cases on Tesla?
So let me do some recent stories first.
Okay.
So I'm going to pull up these stories here because these are important. Tesla's market share in US and Canada is approximately 4%. That's as of Q2 2023.
Listen, they're still a growing company.
Pretty good number.
Yeah, it's a pretty good number for a very much growing company.
Yeah. Tesla hit record quarterly sales in China as market share shrinks, actually.
But why is that?
I do wonder why.
Well, think about it.
Well, China, as far as the records, I mean, I have a number here. Where was that?
Well, the other thing is China is the fastest growing middle class.
From April to June, wholesale Chinese deliveries were about 250,000, up 120% from the year prior. So as they keep building factories over there and delivering cars. It's
Well,
just
and as the middle class keeps growing and growing, it's like
people
the
can
U.S.
afford them, and they're cutting prices, so more people can afford them.
I know. That's the thing
I don't
about
like
Tesla
that.
that's really hurt Tesla lately. They've been cutting a lot of prices.
Like 10 price cuts in the United States. Was it 8?
I don't know the exact number, but it's a lot.
In 1 year.
It's a lot. If you know the number, put it in the comments below. But there's a lot of price changes going to Tesla. And that's, everybody was like, oh, Tesla's, guys, to me, if you're price cutting, what's going on there?
Mm-hmm.
Yeah. So, all right, keep going. Because they know that deliveries are going to really drive their stock price.
Of course. Global market share sits at approximately 16%. Now, this is a huge thing for Tesla.
Wow.
The number of supercharging stations just continues to climb, and I think that's the big competitive advantage that they have. It's very hard for anybody that has an electric car outside of a Tesla to travel around the country and charge.
So I have an electric vehicle. It's the Taycan.
Yep.
Yesterday I drove it quite a bit, and today I want to take it to the office, and I was like, I'm like, yeah, I'll be fine.
Yeah.
I remember thinking to myself, well, if I had a Tesla, I wouldn't even think twice about it. I'd be like, okay, I'll just go to Macedonia and go to the supercharger and be done with it.
10 minutes and you're gone.
So that is one of the big benefits of Tesla, but they're also signing up a lot of companies to their superchargers network, which is a great idea.
They have Rivian. They're starting to, I think GM is in there, Ford may be in there. I'm not sure, but a lot of these new startup companies, Tesla's helping them. They're throwing them a bone.
And this was a very important investment that Tesla made that I think is going to pay off long run.
Yeah.
To me, I believe the days of worrying about Tesla staying in business are
gone. To me, they're gone.
I'm not worried about Tesla being in business 10 years from now.
Right.
5 years ago, I was like, who knows? It could go either way. But I think Tesla has done a great job of solidifying their importance in not just the electric vehicle market, the overall auto market.
Yeah.
Right.
So a couple of bear cases.
Yep.
The price wars continue in China and here in the States. I mean, I had a Model S. I paid about $86,000 for it after tax. It went up to over $100,000, and now it's almost back to that 86 number.
Wow, really?
So yeah, they're really fluctuating prices around, and they have no worries about doing that.
And I want everybody to remember this gross margin right here, which is really good for the car industry, 21.5%. What that means is for every unit they sell, about 21% of the sale price is profit that they can sit there basically put at the bottom line before taxes. That's a big number. But as they cut these prices on the cars, you got to remember they're cutting it on new production, which has higher costs than previous production. Mm-hmm. So that gross margin is probably going to be affected in the upcoming quarters.
Yeah.
Wouldn't you think?
Yeah, absolutely. Gross margins fell for the 4th time in a row.
Did they really?
Yeah.
So wow.
They're continuing to struggle in that department.
So look at this. The last year's gross margin is 21.5%, but their most recent quarter was 18.2. Guys, that's big numbers, especially when your bottom line is high single digits, which is high for a car company.
Yeah.
Now, guys, we've gone over these bull and bear cases. There's probably a ton more out there. Drop in the comments below any bull and bear cases you think we might be missing that are really important. The next time we do a Tesla video, we're going to go back and we're going to pull out the best ones, the ones that got the most votes, and we're going to give a shout out to that user and bring those comments into our videos. So please make sure you engage on those levels. Okay.
Yeah.
So let's go through let's go look at our 8 pillars. Mo, how bad is this going to look? Considering the company is currently selling for 59 times earnings.
A little rough.
Actually, it's not as bad as I thought. Not as bad as I thought.
ROIC is significantly higher than I expected it to be.
Oh, yeah. Guys, so what this means is it's the return the company gets on the money that's invested in the business. Car companies are notorious for having really, really low returns on the money in the business. They're a high capital intensive business. What does that mean? It means it takes a lot of money to keep the business going. A lot of factories, a lot of machinery. That's what makes the car industry so difficult. Now, Mo has a different metric than I do, but again, and if you have our software, you can customize your pillars up to 12 different pillars. So make sure if you have our software that you do that. Here's something I don't like. Net income growth is up 12.9 billion in the last 5 years. Free cash flow growth is only up 4.8. Now again, their capital expenditures are up a lot in the last 5 years. So that's explaining a big part of this difference right here. That's explaining a big part of this difference. But usually I don't like that. And look at this. PE of 152 over the last 5 years, PE of 201 over the last 5 years. Yeah. And they've issued a lot of shares.
So I will say the shares thing, it's fine, whatever. But I don't like it if I was an investor in the company. What I like even less is that Elon came out and teased the idea of buying back shares. Hasn't done it yet, but I didn't even like that he teased that idea.
The worst thing a company of this valuation can do is buy back shares. Guys, this company's price to sales ratio, which takes the market cap divided by the sales in the last year, is 7.6. The average car company is like 0.4 to 0.8. So this is almost 20 times higher than the average car business. And again, for the haters out there, drop in the comments. I know it's not a car company.
Actually, can you please put in the comments why it is not a car company?
No, don't put in the comments. You know why, Mo? Because they're going to say, because they sell software. I'm like, yes, I get that. But how much of their revenue comes from software?
Put that in there too.
They could be in the future a software business. They could be their solar business. They sell a lot of those things. You're right. Put it all in the comments.
Their software is sick. I mean, I was actually driving in my car the other night with my aunt. She had never been in a Tesla. She's like, this is unbelievable. I'm like, yeah, it's really cool. That's why I got the car.
It's a fun car.
It's fun.
And by the way, I pass a lot more of them.
Still a car.
But guys, they're diluting shareholders. This is the silent killer in investing. This is the silent killer in investing. It means that you now have more partners you have to share the money with as they issue more shares. So like, for example, if a company has 10 shares outstanding and you own one, you own 10% of the business, 1 out of 10 shares. If they issue 2 more shares, you still own 1 share, but now you're splitting it amongst 12 investors, which takes your ownership from 10% to 8.33%. And as they keep doing it more and more, it's not a stock split. It is issuing more shares. That is the problem. All right, let's go look at analysts and see what they're saying. By the way, guys, don't fight in the chat. Just have very calm conversations about this.
And for those of you that are new, let's say that Tesla does a stock split tomorrow and the price comes down to $25. It's not cheaper.
No,
it's just not. That they've added more shares, so it looks like it's cheaper when you divide it.
Yeah, don't confuse the price of the stock to the value of the stock.
Yes.
Just because it's a stock split issues more shares, just splits everything by more. That's it. And this is a very common, we have a video about that out there in our community. So check it out.
Yep.
Now, analyst estimates, Mo.
Oh boy.
They're expecting Tesla to make $3.50 per share this year, which is actually 14% lower than last year, but growing and over doubling in the next 4 years. So that's a lot of growth, double-digit growth on their earnings per share.
Yeah.
Okay, so that's a big benefit to Tesla. They still have a lot of growth potential as they get larger and larger.
Mm-hmm.
The revenue growth. So here's what's confusing me. The revenue growth they actually have, I think, faster or just as fast as their profit growth. It should not be that way. If you have a good gross margin, the more and more you sell, the earnings per share should drive up faster than the revenue. But again, revenue is supposed to over double in the next 5 years, 6 years. Okay.
Okay is right.
Okay. So guys, what we're left with here is what price to pay for the company. Now, I'm going to do our stock analyzer tool where I'm going to put in assumptions about revenue growth, profit margin, free cash flow, et cetera. Another thing I want you to do, if you have your opinions on what we should be putting in here, put it down below. Talk about what assumptions you'd make, because there's going to be a lot of widespread differences in people's belief. This is the art of investing. I really want you to sit there and understand and get used to, because in our community of people who have the software, they sit there and the most common thing they do is take a screenshot of this and ask people, hey, what do you think of my assumptions about XYZ Corporation? And guess what? One of the most common questions you get is, Paul, in this video, you did this assumption. In this one, you did this. What's the difference? And I'll comment, hey, that's a great point, but this is why I did it different. That's the art of investing. Our job is to make low, middle, and high assumptions. And the more unknowns there are, the wider these assumptions are going to be. So please make sure you discuss that in our community, in our chat below. But guys, if you like the software, go to everythingmoney.com. We have a special 20% off. You get everything we've gone through today, plus all of these tools that are listed here in our entire community. You get 8 or 9 tools for about $1 a day. It's a no-brainer. Check it out. We're running a special right now, 20% off. So Mo, we're going to do the revenue growth numbers here.
Okay.
Now, the good news is that their 1-year ROIC is actually 13.9%. I'm kind of surprised by that.
Yeah.
We're going to do a 10-year analysis on Tesla. Mo, what revenue growth numbers do you want me to put for the next 10 years, considering the last 10 years was 50% growth per year?
So I did 12, 18, and 24.
Okay. So on the high side, 24% increase over 10 years takes the company 9 times larger. So it would make it about a $800 billion revenue business. That's a big number
for a car company.
That's a lot for a car company, especially one that's decreasing prices right now to get more market share.
Right.
Profit margin, Mo. Increasing profit margin here, but they were also a growing company still.
Right. So I did 6, 9, and 12. This is a tough one.
It is a tough one. I actually love your assumption. I actually love 6, 9, and 12, and here's why. 6 would be good for a car company. It wouldn't be incredible. 9, if they're able to generate other areas of business like their software at a higher margin, and 12 if they absolutely crush it. The only thing I have apprehension about is, actually maybe 5.
I know. I was lower and then I creeped it a little bit higher. This is a hard one. It really is.
Here's what I'm gonna do. I'm gonna do 5, 8, and 12. I'm gonna still keep the 12 on the high side because if they really do crush it and they are able to get 12, but remember, guys, they've only done 13% once in the last 10 years. They've averaged 6.4. So it's okay to be a little more conservative. But again, it's still a car company. That's always what's gonna drive. Warren Buffett always says, you take a good manager into a bad industry, the industry is gonna work out.
Mm-hmm.
That's what's gonna end up happening for the most part. But Tesla could end up being the Southwest Airlines of the auto industry. That could happen. And if that happens, this could happen, 12%. Now, what about free cash flow?
Now, would you make this the same?
I would.
Okay. Historically, it hasn't been that, but I do think that it eventually it has to get to that point.
Well, yeah, and also they're spending a lot on
and it's a lot of CapEx.
On growing their revenue. So I'm okay giving them that same metric over the long period of time. In fact, I'm only going to focus on earnings here, profit margin here for this company anyhow. Now for PE, guys, this is the hard one because the current PE is 59. The market average is 15. What I always recommend people do, because it's a very common question we get in our community, is how do I make my assumptions on PE? The market average 15. I go higher with a higher return on invested capital, higher growth rate, and a higher moat, and a bigger moat. And I go lower for the exact opposite. Tesla has a lot of growth potential. The return on invested capital might be tougher because of the industry it's in. And the moat might be tougher because everybody's entering you already see that, a lot more car companies are entering the electric business.
Mm-hmm.
And established ones. Doesn't mean they're going to win. Doesn't mean they're going to do well. But I don't think it's going to be only Tesla dominating this market. So, Mo, give me your PEs on this one.
So I did 18, 21, and 24.
Higher than I would have done, but I have no problem doing that. Same with the price of free cash flow.
Yes.
I don't think, for me, a car company shouldn't get that, but it is 10-year growth rate on a growing business. So I'm okay paying a premium for that because they have a lot of growth potential. And that's what's really going to drive my PE here. I should be willing to pay more for better growth. Mm-hmm. If you had two companies exactly the same, one can grow 20% a year, one's going to grow 5% a year, which one would you pay more for today? Everything else is the same. Profit, of course, a 20% growth. And that's why I'm willing to pay a higher premium growth rate, PE, for Tesla. Now, finally, guys, our desired annual return. This is where you basically put your margin of safety in. You can get 9 or 10% by investing in a long-term ETF. So as you make higher and higher assumptions, and as there's more likelihood of things not happening, you got to get some sort of margin of safety. So you need to get yourself a higher desired return. Mo, what return would you want on these based on these levels?
I put 11, 14, and 17%.
Okay. 11, 14, and 17. I probably would have done 12, 14, and 16, but I'm fine with it. Except to me, I don't think Tesla's I don't think 11%. I think there's a lot more that can happen here that would be worse for Tesla than 11% return, but that's my opinion. So we're going to hit the analyze button, guys. Now I want everybody to remember, there's going to be a lot of numbers that pop up here. Stay with me just a minute or two longer on this video because we're going to explain the numbers and we're going to explain some things of how we look at this. It's important because Tesla is one of the most talked about stocks ever. So let's get into the numbers right now. Based on our assumptions, we have a low price of about 40, high price of 180, middle price of 88. If you pay today's price of 226 and Tesla's low assumptions occur, you're going to lose about 9% a year. If the middle assumptions occur, you're going to make about 2.5%. And if the high assumptions occur, you're going to make about 14%. So you basically have to get the highest of high assumptions occurring for you to make a good return on your money.
Yep, it's true.
Guys, thanks very much. Again, everythingmoney.com, 20% off, about $1 a day to have all of our software and really take control of your finances. Thanks a lot, guys.